Good morning, everybody. Welcome to another instalment of this virtual investor webinar series. My name is James Sharp. I work on the capital markets origination team at the exchange. Just a couple of little things from me as ever before we go through to our presentations. So this is an interactive session. We do encourage questions to be asked. To ask a question, please do so via the box, the free text field that you'll see on your screens. We'll cycle through as many of those questions as we can throughout the session. Anything we don't get to, we will get to if we can after today. So without further ado, I'd like to introduce our first speaker, who is on the screen now. So Dean Anderson, Chief Executive and founder of Kernel Wealth. Kernel is a wealth management platform and index fund manager who strive to create industry-leading investment opportunities for Kiwi investors. They offer a range of low-cost index funds and retirement planning via their KiwiSaver offering. Dean, the floor is yours. I should be back in a few minutes with some questions. Thanks very much.
Good morning, everybody. So hopefully you can now see my screen. And thanks, James, for organising today's event. As the James mentioned, do welcome questions as we go. So James will share those and happy to dive into any sort of topic. I thought I'd give a bit of an overview of who Kernel is, a relatively new player on the scene, talk a little bit about index investing and some of the other sort of conversations we've been seeing in the market over the last little while. So as James mentioned, I'm the founder of Kernel. We've been running now for 3 years. We're based here in Auckland and we cover a range of services. So who is Kernel? We're a fully licensed fund manager. So we have an MIS license through the FMA. We were founded and launched in 2019. So we've actually just had our 3rd birthday. Over the past 3 years, we've been building out a range of products in the index space, covering domestic and international equities. And we've grown our team from 3 staff to 30, all based here in New Zealand, building new products and solutions, including a full online investing platform. So we're very proud to be a Kiwi company. Equally, we're very proud of, I guess, the wider social factors that we put at our heart. So that includes being an accredited living wage employer. We offset our limited carbon that we produce, and proud supporters of the pride community. As a business, we're very passionate about trying to create a wealthier New Zealand, and that's about embedding good saving and investing habits. So the products we design, how we operate our business, the education and content that we put out there is all designed around good long-term saving and investing habits. And I think that's a key thing here, that actually good investing is all about habits, less about percentages and dollars. And it's something that we've been doing since we launched, including very recently traveling the length of New Zealand to hold a range of investing webinars, investing education events as part of the annual Sorted Money Week. I won't spend too long on this, but happy to dive into it. Obviously, everything that you need to know is on our website, including the product disclosure statements. But I just wanted to highlight that we do offer a broad range of products now. So over the past 3 years, we've grown from just offering New Zealand only index funds to covering a broad range of themes and styles. So international equities, sustainable investing funds, including thematic funds. And more recently, as part of our KiwiSaver launch, we launched our first diversified fund, which is a high growth fund. All of these are index tracking. All of the indices that we have, we physically go and buy and hold all the underlying assets. We do that all in-house here in New Zealand with our own systems that we've developed. Also this year, we've sort of expanded. Obviously, we have an online investing platform, so we work across the spectrum. Our client base includes financial advisors, iwi, charitable trusts, other fund managers, and then our direct to retail platform that we've built. So this full online investing platform covers 3 core pillars. It's got the online investing accounts, an online savings account, and now also the addition of a KiwiSaver platform that enables investors to basically manage and build their own KiwiSaver using any of our funds. But I thought in today's session that I'd talk a little bit about briefly what is an index. Often we hear about index funds and ETFs, but I'm not sure that everybody fully grasps what an index is. So as you can see on the line there and the tickers that you'll be very familiar with, the NZX-50, NZX-20, you'll see these numbers and metrics every day, but what does that actually mean? Well, put simply, an index is simply a measure of a basket of assets. Typically, we think about the NZX-50, it's the 50 largest companies listed in New Zealand. Indices have actually been around since the late 1800s. I think it was 1896. Charles Dow, Edward Jones, 2 journalists who created what is now synonymous with Dow Jones Indices. They actually made those, developed their first index as a way to summarize what had happened in the market without having to report on every individual constituent. So it's simply a measure of the performance of the constituents that in that index. Commonly, most indices that you'll see, the big headline indices that you'll be familiar with, S&P 500, NZX-50, they're market cap weighted. So that means the bigger the market capitalization of the company, the bigger the weighting in the index. And then they will often have what's called a quarterly rebalance. That is where the index will be assessed to go, okay, is company number 50 fallen in value, that they're now falling out of the index and being replaced by a new constituent. So that is kind of the general mechanics of an index. But with the advances in technology, you can kind of get any sort of style or investment strategy delivered in an index. Put simply, it is really just a set of rules that can be turned into a hard methodology. So you can get index styles now that are based on factors or styles, like it may be designed to capture higher dividend paying companies, sector indices, equal weight, or even down to thematic indices, where it's finding companies that are aligned around a particular theme, such as renewable transportation. So there's been a big shift towards indexing over the last few years. Still, we lag a little bit here in New Zealand, but what many won't realize is actually we were the 5th country in the world to have ETFs. 1996, we had our first exchange traded funds here, which were index based, and we were 5 years ahead of Australia. But particularly over the past decade, we've seen a big shift towards index investing. The US now is estimated that sort of between 35 to 45% of the market is held by our index funds. One of the major drivers of this has been performance. Performance is one of the triggers that has resulted in investors shifting their money out of actively managed strategies, where an investment manager is hired to go and select winning stocks and winning times, into simply owning the market by an index fund. Spiva is a fantastic resource. You can see the website down the bottom hand corner of this, and I encourage you to go have a look at it. What it has is a range of data in there based on individual countries over 1, 3, 5, 10, even in some markets 15 and 20 years. And you can go and break down even by sector. So the bubbles on here show the percentage of actively managed funds that have underperformed the benchmark over that comparable period. So as you can see, in a lot of markets for the majority of the time, that these numbers over a sort of a 10 to 15 year period typically get up to sort of 90 to 95% of actively managed funds underperform simply owning an index equivalent. So this is really common. You'll hear this talked about a lot. There's a massive industry debate. It's been going on for decades now, and there's a significant amount of data and research behind it all. But one of the things that we often don't talk about is a little bit of the why. So I thought I'd just take a few minutes to kind of explain why indexing actually works, not just the results of it that are driving investors to look at index funds, but actually some of the rationale and the reasons that are the triggers for it. So there are kind of 4 key things that have been driving the shift towards indexing and make indexing work in the market. Now, the really obvious one that we know about is costs. Actively managed funds employ whole teams of research analysts who expect to be paid significant amounts of money, whereas an index fund is very systematic, it's data driven. As a result, you tend to have a difference in fees. So if an actively managed fund is 1.2%, but an index fund is 0.2%, that's a 1% hurdle that the active managers have to overcome every single year. So investors have realized actually shifting out of higher fee funds into a lower fee fund is saving them a significant amount in fees. So over the past 24 years, it is estimated in the US alone that the amount of money saved in fees from investors shifting out of active funds into index is over $500 billion. Now, New Zealand is a relatively small market, but for context of actually how big fees are and how big they're going to be, industry estimates are that over the next decade, there's going to be $15 billion paid in KiwiSaver fees. Now that's a fairly small, fairly conservative estimate actually. So $15 billion is going to be paid to investment managers in fees over the next decade. If 10% of investors shifted out of an industry average fee into a lower fee fund, that would save about $1 billion in fees over the next decade. So that gives some context as well. And obviously we saw how much media coverage just the discussion on GST and investment fees triggered, but you can see how much fees in general compound. The other ironic factor that has driven the result of indexing and why indexing in the US started in the 1970s and not say in the 1940s is actually the professionalization. It used to be that the stock market was owned by mum and dad investors. 90% of trading used to be by mum and dad investors owning stocks, often in companies that they worked for. Over the past few decades, the sector has become institutionalized. Now, 95% of assets are owned and traded by giant institutions and professionals. We're now over 150,000 CFA holders around the globe, another 150,000 holding it. There are hundreds of thousands of Bloomberg terminals. Investment managers are competing for microseconds to be able to trade in fractions and get down those ultra efficiencies. Today, the average investment professional is significantly smarter than they've ever been. However, it's not the absolute skill that matters, it is relative. 40 years ago, 60 years ago, it was a lot easier to be an active manager because as soon as you started reading a financial statement, you had an edge over the majority of the market, being mum and dad investors. You could find ways to generate alpha. Today, it is active professional, PhD holder versus PhD holder. You may be smarter than ever before, but it is the relative skill that matters. So ironically, it's the professionalization that's actually made indexing work, which is why, despite indices haven't been around for a long period of time, they started, the first index fund was launched in the 1970s in the US, and that was a period where the market had become sufficiently professionalized that that competition was starting to show up. There are also a couple of mathematical and structural things that make indexing work, and I did want to just quickly touch on these because I thought, again, they're relevant to understand a little bit about the challenges of investing and the challenges of active management. And one of those is dispersion, the other is skewness. These are relevant for all investors, no matter whether you're buying your own stocks or whether you're buying actively managed funds or index funds. It's important to understand some of the dynamics. Dispersion is actually a really simple one. It's easy to represent on a visual basis. It doesn't really matter the periods here, but the idea is the red line is 2 identical months of the Dow Jones Industrial Average Index. Both months, the index was up 3%. The gray lines represent the performance of the companies in that index over that period. So on the left, you can see what's called high dispersion. The range between the best performing companies and the worst performing companies is high. On the right, that's low dispersion. Collectively, both months delivered 3% for the index, but you can see how there is variation between a range of opportunities. So periods of high dispersion are opportunities or greater opportunities for active management and stock picking to add value, because obviously if you get the best performing company and don't hold the worst, that is a significant difference. Whereas on the right, what you've got is low dispersion. And if you look at it throughout history, often dispersion is relatively low. Where we see dispersion increase is these little periods like the GFC, like when COVID hit, where the range increases, but it tends to be relatively short-lived. So in a low dispersion environment, when the range of returns between companies is narrow, no matter how much insight you have, the value add from being able to select those that outperform is so limited, and that makes it challenging, particularly when coupled with cost to outperform. The other one that I wanted to briefly touch on was an interesting thing called skewness, which is sort of the most mathematical. Now, apologies, this needs to be updated, but it gives a good sense, and this tends to hold true across all markets, most time periods. If you ask somebody what you think the probability of picking a stock that performs above average is, most will naturally jump to a 50-50 conclusion, right? But the reality is equity market returns are not a lovely bell curve like most things that we sort of talk about. Instead, they've got this skewness. So what we've done here is simply plot the return of NZX-listed companies over that December 2003 to December 2019 period. So you can see there are about 17% of companies over that period gave investors a negative 50% to negative 100% return. This shape and sort of ratio is pretty similar in most markets across the globe. So you can see that about 5% of companies gave investors a return of 10x. And that's fantastic, right? If you can find those and hold them in advance, it doesn't matter what the fees are, that will give you a phenomenal return. But importantly, the median return, so half of all companies over that entire period gave investors a return of 62% or less. In fact, over 30% were a negative, it was 0% or less return. The average was significantly higher than the median at 248%. If you add up all of the bars below average, about 75% of stocks perform below average, and that's pretty consistent. Again, consistent across markets and locations. The average is pulled up by those 5% of stocks that do phenomenally well. What this shows is that picking individual stocks is actually statistically very challenging. The odds are against you before you get started. Probably more critically though, for the average investor, it's a great reminder of why diversification is so important. Because just owning 1 or 2 stocks, you have very high odds that actually it's going to perform below average, below median. So to get average, you need to own the market, and that's why indexing is such a powerful tool, because you can get broad diversification from the very first dollar. It doesn't mean that stock picking is bad. In fact, what we encourage you to do is get a mix of both. The thing that we talk about often is core satellite investing, where you have a core of your portfolio into well-diversified index funds. That's going to ensure you get the average, and then you can have your satellites, smaller percentage of your portfolio that may be in actively managed funds, private equity, other things that aren't critical to your long-term financial success but could enhance it. For most investors, the idea of betting a whole retirement saving, trying to chase the 5% of stocks that perform 10x, is probably not necessarily a wise investment decision, particularly given the fortitude that's probably needed, because these companies will, like any other investment, have periods where they're significantly down, and that emotional ride of holding those to see them out to the period where actually get the 10x is very challenging. I think it's just an important reminder that for any investor, one of the things to think about is always, what is your financial goal? Unless you understand what you're investing for, your time frame that you're investing for, it's very hard to determine what an appropriate mix is. And I guess before we jump to some questions, I just wanted to highlight a couple of things about how it's easy to be very reactive to the news, and how you've got to separate investment decision making and your investments from the noise of the markets and the general emotions of the market. Media loves dramatic headlines. They love clickbait. They love things that are controversial. And I'm sure many people have heard and seen most headlines talking about recessions, inflation, the worst equity market returns in 50 years. Interestingly though, this sort of headline doesn't get cut through. It was actually for the US the best July in 80 years. So it's a reminder that it's actually the value of trying to time the market is not there, and you shouldn't actually make investment decisions based on the short-term noise of markets generally. It is about being in the right asset allocation for your investment horizon, not reacting to market noise and the short-term nature of the general investing cycle. I will just maybe quickly touch on this. I encourage, we've got a blog on this on our website. We actually recently just updated an old blog that we had, and hopefully see this, an old blog that looked at the value of timing the market, where we made several assumptions around an investor who was putting $100 a week away, and did the analysis of, okay, over the past 20 years in New Zealand, I think there's been 7 periods of 10% decline or more. What value do you get from timing the market and investing perfectly on the down day, the very bottom of the market, versus what do you get if it happened if you invested actually at the worst days? The premium that we found for somebody who was regularly investing over 20 years, the premium for finding 6 days over 20 years to invest was 7%. So the idea that if you've got disposable income and you're accumulating wealth, and that timing the market and going, actually, I'm not going to invest yet, I think the market will go down further. What we found was actually the value from that was 7%. And if you think about the impossibility of that in terms of having to analyze the market, be distracted by headlines, and try and find 6 days of 20 years, it's just not worth it. Basically, the short story is there is very limited value to be gained from timing the market. And for context, one of those days was about a week after 9/11 as well. So it gives you a sense of how much challenge there would be in actually doing that. A couple of final things, if I can just share my screen. Oh, a couple of the final things that I would just sort of touch on, that we see commonly, I think, is I think a common mistake, particularly with how KiwiSaver is growing now, that we're seeing a bit of commentary on, and again, coming back to those media headlines, it's very frustrating when we see media headlines like KiwiSaver loses, $5 billion in 3 months, etc. These are just unnecessary headlines that trigger people to make decisions that aren't in their best interest. Concerningly, though, I want to flag why having these conversations, the fact that you're on this call means that you are engaged and you are thinking about investing, you are thinking about how to manage and build your wealth. Reality is most Kiwis aren't. I encourage you to go out there and talk to others about this, because when we did a survey before Money Week last month, 1 in 5 respondents did not know who their KiwiSaver provider was. So it's critical that actually if we're going to build a healthy financial ecosystem here, a prosperous New Zealand, and KiwiSaver is a very significant asset for New Zealand's long-term economic growth, that we have better engagement and awareness of what's going on out there. James, I'm conscious of the time, so was there any questions that you wanted to jump onto?
Thanks so much, Dean. Really fascinating presentation. In particular, I thought about your point around the relative smartness of investors over time. Very, very interesting, as well as your points around dispersion, skewness. I do have a couple of questions. I was wondering, just going back to that dispersion point, what's actually caused that change from historical to what we see now?
Well, if you actually create a standard deviation of it, you can basically plot a singles dispersion line, and you basically see these little spikes that go up, and it's just natural market stresses. Interestingly, correlations between stocks have actually been rising. So even this year, despite the market conditions, the correlation, i.e. the movement of stocks collectively, has actually been rising. Where we're seeing actually dispersion that has increased is actually so far this year been between sectors. And that's pretty obvious. Any investor who's been out there will sort of know, look, energy as a sector has significantly outperformed, while sort of growth in tech is. So we've seen a massive dispersion change between sectors, but actually the correlation of individual stocks has actually been trending up over time. So some interesting factors there for investors to think about, and which is where most people have made sort of any decisions. Again, that sort of sector macro level is actually a lot easier to think about than actually an individual stock level. Interesting.
Excellent. Okay, just going through a couple of questions here, and please do send us through even if we don't get through today. I've got, there's quite a fundamental question here actually. So it's why is the equity market always expected to appreciate over the longer term, which I guess is key to index as well as any other types of investment?
Yeah, so it's the reward for the greater risk of being a shareholder versus, say, a debt issuer or a lending debt to a company in terms of your priority on the balance sheet if something goes bust with that company. Now, that is effectively that premium that comes from owning shares. Interestingly, if we look at the New Zealand housing market, or New Zealand in particular, over the long period of time, actually, NZ equities have outperformed property, residential property, including Auckland property. The major fundamental difference there, though, is the leverage that you get. So that is basically the risk reward. I guess the key, though, is that you can control or better control that risk. There are more tools today to control the risk that comes from investing, and habits and behavior are actually key. Being diversified, as everybody knows, is critical. Not timing the market, not reacting to short-term noise. You can really control that risk to get a better outcome as an investor. Okay. One thing I would encourage, that a book that I don't know if you've read, James, actually, but it's quite hard to get hold of, is Bulls, Bears and Elephants, The History of the New Zealand Stock Market. And it's a fantastic book. Must be 5 or 10 years old now. I think Victoria University have a copy of it, but it looks at the history of the New Zealand stock market right back to the gold rush, when we had these regional stock exchanges and how they came together. I think it's a fantastic book for any investor who wants to have a bit more understanding of how do we end up where we are today, what was the history of New Zealand when it comes to stock markets, the evolution of them over time. It's a really great foundational book.
Well, no, I haven't read that, Dean, but a great recommendation. I definitely should do so. I'll let that everyone sort of take that one away as well. Fantastic, thanks, Dean. Perhaps one more. So how should first-time investors approach the market? I mean, you've talked about some of those kind of key points, but is there any of those key do's and don'ts you want to sort of reiterate? I think for the purpose of that education piece.
First-time investors, I'd really encourage you reading that Timing the Market blog that we did, because it is done on the scenario of somebody that's putting away $100 a week. So somebody's got disposable income that's accumulating, that has time on their side. It kind of highlights as well the value that comes from just regularly investing in habits. The most powerful contribution to growing your wealth is nothing to do around having to pick stocks or time markets. It's the habit of going, actually, I'm going to put $100 a week away. I am going to be an investor for the long term, and I'm not going to react to short-term noise. If you can nail those emotional factors, that will give you a far better outcome than 99% of other investors, right? And so I think that is the key thing to think about, and making and finding a platform or an experience that is aligned to you. It's a really interesting one. As an entirely digital business, we have this tension of everybody wants things 24/7, and we want to have this great digital experience, but actually good investing would also be not looking at it. So that you get that engagement of, almost our challenge as a team is how do we build the best one-time experience? How do you get somebody to come in, set up their investing plans and investing strategy, and then forget about it and not look at it? That's actually key.
Excellent. I think we're going to leave it there in the interest of time. Fantastic insight. Do fire through any questions you have for Dean. We can get them over to him. Dean, thanks very much for joining this morning, and catch up with you soon.
Cheers.
Cheers, Dean. Thank you very much. Excellent. We're going to go on to our second presentation now, and it's a pleasure to welcome Greg Balla, CEO of AoFrio. AoFrio, formerly Wellington Drive Technologies, are one of the world's leading suppliers of advanced electronic IoT solutions for the commercial refrigeration industry, helping refrigeration OEMs and food, beverage and retail brands across the globe reduce their costs, increase sales and become more sustainable. It was fantastic to see the new AoFrio ticker, AOF, go live on the exchange this morning. And with that, over to you, Greg. The floor is yours. I shall come back shortly with a few questions. Thanks, Greg.
Thanks, James. Morena, everyone, and thank you for the NZX for hosting this session today. As James has said, this has ended up being a well-timed webinar for us, as today our ticker on the NZX changed from WDT to AOF as we start our journey of changing our name from Wellington Drive to AoFrio. Today I'm going to talk through what we do as a company, our financial performance, our growth strategies, and why we're rebranding. So just a little bit about us. We started out in 1986 as Clark Automotive Developments and changed our name to Wellington Drive Technologies in 1996 as the company focused on electronically controlled motors. In February 2001, we listed on the NZX, and it's fair to say it's been quite a journey for us from them to where we are now as a leading provider of Internet of Things, or IoT solutions, and energy efficiency motors to the food and beverage industry. Across the globe, we supply advanced electronic IoT solutions for the commercial refrigeration industry, helping refrigeration manufacturers, or OEMs, and food and beverage companies and retail companies reduce their costs, increase their sales, and become more sustainable. So what this really means, if you think about our actual industry, if you go to the corner dairy and you see those row of refrigerators in the dairy, the Coke fridge, the Pepsi fridge, the Red Bull fridge, they're the types of commercial refrigerators that those companies that we work with. And being able to connect those refrigerators to the cloud and provide data for them about the performance of those refrigerators is hugely valuable for our customers. So I guess through this type of innovative technology that we provide, we allow these customers to improve their operational performance and build a more sustainable world via energy reduction. As an example, our motors technology and our IoT technology have already allowed our customers to save more than 12 million tonnes of CO2 emissions. That's equivalent to running Huntley Power Station for 4.5 years. As we've evolved as a company, we found that our brand was out of step with what we offered to our customers. And so this is one of the reasons why we've decided to rebrand. But we just didn't do this randomly. You know, we invested in a program of research on our business, and we learned that our Aotearoa heritage is a really powerful differentiator for us, and it gives us a real strength in our global markets. We also learned through this research that we're really held in high regard for our IoT solution, I guess helping our customers with powerful insights about their business performance that comes through both our software and our hardware. By harnessing what our customers love about us and innovating further, we're really evolving as a business for the future. We're really becoming a hardware-enabled SaaS company. And this is why we've decided it's time for us to rebrand. It's time for us to create a new brand that showcases what we've evolved into. And in the final quarter of this year, we'll complete that rebranding with new customer communications to articulate the value that we're adding to their companies around the world. As part of this work, we're still working through the branding structure, and you won't see the Wellington brand disappear completely, but we'll have a brand structure with AoFrio as our principal brand. The Wellington brand, which is really synonymous with high efficiency motors, is going to continue. We also have another brand, which is iProximity. iProximity is a consumer engagement platform that allows us to communicate with customers and consumers at the point of sale. But our primary brand, the AoFrio brand, is supporting our IoT ecosystem. That is the technology that we use to manage and run commercial refrigeration fleets around the world. Before I move on to the financials, I just wanted to give you a quick look into the AoFrio brand and how we're positioning ourselves. So our vision for our company is focused primarily on that IoT vision. It's about having hundreds of millions of AoFrio connections, driving powerful, purposeful outcomes for our customers. Our mission is to really continue to scale new heights for commercial refrigeration through innovating and creating sustainable, transformative technologies. Our purpose is through this innovative technologies, we're able to unearth powerful customer outcomes. And the promise that we make to our customers is to help them unleash peak customer performance. So that really summarises our brand and our positioning of our organisation. And so now I'm just going to go on and talk through our financial results for the first half of FY22. In FY22, first half, we reported revenue of 31.9 million, which is up 4.4% on the first half of last year. Since the beginning of the financial year, we've had, experienced huge ongoing supply issues, including electronic component shortages, increased input costs, constraints on shipping, and increased shipping costs. As a result of both of these things, both our EBITDA and our pre-tax profit results were down on the same period as last year. However, given the supply constraints that we faced, we consider this a solid performance. But looking forward, our focus has always been on the longer term growth. And while the supply chain challenges have impacted our bottom line in the first half of the year, we are on track for a really strong second half and expectations of even stronger FY23. We've certainly seen that demand has outstripped our ability to supply on all fronts in the first half of the year. But I'm really proud of our team as they've worked really hard to navigate and offset the impact of the supply chain And that's represented in the fact that we still grew 4.5% in the first half of the year. Wherever possible, we prioritise protecting our customers during these challenging times. And what that meant is we invested in inventory, we invested in redesigning our products so that we could use alternative components to ensure that we could continue to supply. We had to update our firmware and our software to support these alternatives that we were creating. We also invested in inventory of components so that we could deliver against our forecast in the back end of the year. And now we feel we're in a really strong position because we've secured enough stock of our key components that we can, that we'll need for manufacturing over the next 12 months. One of the other implications of the supply chain challenges was that we had to buy products on the spot market. We had to pay premium costs for freight and shipping, etc., to make sure we could supply as many customers as possible. And this did have an impact on our EBITDA performance, but it was a real deliberate decision to make sure we kept customers so that we can have a strong second half of the year as we resolve some of the supply chain challenges. I guess now really what I would like to talk to you about is, as we started to get through some of the supply chain challenges, we're really focused on the growth phase of our company. We've recalibrated the way we work and really focused our organisation on becoming this global hardware-enabled full-service SaaS company. And I'll explain to you a little bit more about what that means. But what we're seeing is that this is our pathway for lifting recurring IoT revenue, expanding in existing markets, and exploring new regions around the world. We're firmly focused on meeting the needs of our global customers, delivering them clear, valuable insights and sustainable transformative technologies. Connecting all of this is really powerful for our customers. How we do this for our commercial refrigeration customers, we talk about 6 value pillars, and I'm just going to talk to you a little bit about what those value pillars are. The first thing which may surprise you is around asset management. But in some regions of the world, particularly Latin America, customers lose up to 15% of their refrigeration fleet each year. And our technology has allowed customers to significantly reduce that. So we're able to track where these commercial refrigerators are and help them reclaim those refrigerators or keep them where they want them to be. The second element is technical performance. An example of this, we've been able to use AI and machine learning to help one of our customers reduce their maintenance cost of their fleet by up to 50%. So technology driving powerful outcomes for our customers. Our next value pillar is around commercial performance. This is about helping customers maximise their ROI or maximise the revenue and cost performance of their refrigeration fleet. And so what we're able to do is help them understand whether they've got the right size of the refrigerator in a location or whether they need a second refrigerator in that location. So again, it's helping them optimise their commercial performance. The next value pillar that we talk to our customers about is operations management. And this is about sustainability. It's about helping them ensure that they're managing the refrigerators effectively from an energy management perspective. 15% of the world's electricity consumption is consumed by commercial refrigeration. So it's a huge opportunity to manage that energy usage around the refrigerator. So a combination of our controller technology and our smart motors allows us to really optimize the energy use of a refrigerator. And the final 2 pillars are around customer engagement and consumer engagement. Customer engagement is, so brand, for example, Coke or Pepsi, if they want to communicate with that dairy owner that I talked to you about, well, how do they do that? traditionally, they used to have to jump in a car and drive out to the location to talk to them. But with our technology, they're able to communicate electronically with their customer and share things like planograms. And a planogram is, what should the cooler, how should the products be put in the cooler? Is there a promotion on? Do they need to rearrange that planogram to optimize it for a promotional period? And these kind of things really help our customers with their engagement with their customers, if you like, all electronically. And finally, the consumer engagement, this is allowing brands like Coke or Pepsi or Heineken to be able to communicate with you or I as we go past the cooler, and to allow them to share information around specials that you may be entitled to, or those kind of things. And as an example of that, one of our customers over a 6-week period of promotion using this consumer engagement platform increased their revenue by 114% from that refrigeration fleet. So these have real impacts for our customers. The next thing I'm going to talk to you about is our 4 key growth strategies. The first one is around growing customer maturity. When our customers started out with IoT, you might say you consider them as base customers. They start out with a basic understanding and want basic information about where their refrigerators are, or getting some standard communication around temperature or the number of times the door opens. And so most of our customers start off with a pretty basic understanding. But for us, we have these 4 stages that we like to take our customers through up to that engaged level, where they're really using some of more sophisticated software and solutions around machine learning and the consumer engagement kind of strategies that I talked to you about. But what this means is, as we take customers on this maturity journey, it really is allowing us to increase our recurring revenue fees and our professional services fees. So this is one of our key growth strategies. It's working. We have customers spread across this maturity model now, but it's a key foundation, like I say, for growing recurring software fees. On this slide, I just really, our second, third, and fourth growth strategies are, well, all 4 are on this slide, but our second, third, and fourth ones, our second strategy is around increasing the share of new refrigeration units connected to the cloud. And for us, that means entering the North American and EMEA markets, and I'll talk to you a little bit more about that. The third growth strategy is around connecting existing refrigerators to the cloud. So each year, only about 10% of a refrigeration fleet is new, and the other 90% is already out there. And so this strategy is about connecting that 90%. And again, I'll talk more about that. Our fourth growth strategy is around entering new segments with new solutions. So they're the next things I'm going to talk to you about, those 3 additional strategies. So in the market that we're in, which is predominantly today, is the bottle cooler market. Again, Coke, Pepsi, Heineken, Red Bull, those types of customers. We estimate there's about 90 million of those bottle coolers in operation today. And so that means, as I said, a refrigerator lasts about 10 years. And so there's about 9 million new bottle coolers produced each year. In the markets that we operate, we estimate there's about 3 million available from a market for AoFrio to connect. And currently we have about 25% market share. So we have a real opportunity to grow our share. And how we're doing that is by entering the North American and EMEA markets. So previously we haven't had technology available that really allowed us to have the right solution for those markets. But this year we're launching, or actually in October, so coming up next month, we're launching our product called Network Pro, which will allow us to connect the North American bottle coolers and the EMEA bottle coolers to our cloud. And so that gives us a real growth opportunity. That's about 1.5 million of those 3 million are now available for us as a market to capture. The third growth strategy that I talked to you about briefly is this retrofit market. So in the market, there are about 90 million bottle coolers, as I've talked to you about. And in the market that we have access to, that's about 30 million. So that's the size of the market that we feel we can retrofit. And retrofit means not putting your equipment in when the product is being manufactured in the factory for the first time. It's connecting all those coolers that are already out there in the market. Today, there's about 2.5 million of those 30 million connected. 1.5 or 1.7, as it says on the screen, are connected to our cloud. And so we have a real opportunity to connect the remaining 30 million to our cloud. We have one of the best solutions available in the market, and we're already starting to see the results of customers deciding to retrofit their fleets. So this strategy around retrofitting is already working today, and we expect to see real acceleration as the solution for retrofitting has only been around for about 8 or 9 months, and so getting customers lined up to start retrofitting their whole fleet has been a key focus for us. I guess this is just showing you the kind of growth trajectory of our connected devices. We started back in 2016 with this solution, and we're accelerating. So our strategy of both taking market share, which is the blue box, or ensuring that we're successful in those new refrigeration units, that's what the blue box is. And as I said, the retrofit market, which is the biggest market, only just starting to be explored, but we're accelerating. So strategy is working well. The fourth growth strategy that we have is around entering new segments. So as I talked to you about, the total refrigeration market is huge. It's about a $32 billion market. And what that means is there's about 1 billion new refrigerators manufactured each year. In the segment that we're currently in, that's about 9 million of those billion. So there's plenty of other segments to look at. And we feel we have some technology that allows us to access other market segments that are quite adjacent to us, that have similar problems to the value pillars that we've already talked about. So the ice cream market, for example, a really big market in certain countries, New Zealand, Latin America, and North America. So really big opportunity. There's restaurant chains. In a typical restaurant, they have 5 or 6 refrigerators, and they have real challenges about maintaining temperature control and reporting on the temperature control within their refrigerators. So these are opportunities for us, and we're developing our innovation engine to allow us to address these particular markets. So just confirming where we're at from a financial perspective and our guidance for the year. In response to our first half, as I said, we recalibrated many aspects of our business and have set ourselves up for a strong second half of the year. And on the basis that there's no real material changes in circumstances, the board and the executive team, we've reconfirmed the full year guidance at our interim results. We expect our US dollar invoice revenue to be in the range of 55 to 60 million, which is a year-on-year growth of 17% at the bottom of the range and 27% at the top end of the range. And considering the supply chain challenges we have, that's still an outstanding performance for our organisation. EBITDA earnings are expected to be in the range of $3.5 to $4.5 million, which is significantly above what we recorded in FY21. We expect 3 very large revenue months in the last quarter, and if we're successful, we'd certainly be towards the top end of that guidance. So to summarise, we've rebranded our company because our business has changed. We're no longer only a high efficiency motors company. 50% of our revenue now comes through our IoT solution, and we wanted our company to reflect this. And this is where the bigger growth potential is. So reflecting our organisation or focusing our organisation on that IoT part is really key. We have a robust growth strategy for our organisation, and a global team of experts committed to delivering value to our customers. We are investing in innovation and our people. Today, we are AoFrio, and we're excited about the opportunities we have ahead of us. Thank you, James. That's my presentation. I'm open for questions.
That's fantastic. Thank you so much, Greg. Covered a lot of material there, particularly interesting around that kind of IoT global sort of cloud piece, or kind of that enabling of that technology. I didn't know that the 15% of the global electricity usage was actually from refrigeration, so really significant. And in particular, the $32 billion market you mentioned. Just a couple of questions I picked up here. I guess you've already covered some of it, but maybe as a part of kind of reiteration. I mean, we've got a question here that says, please could you explain how the use of IoT technologies benefits your customers? I mean, do you want to call any of those key call-outs in terms of those tangible benefits? That's probably worth going over again, actually.
Yeah, so from an IoT perspective, you know, as I said, our customers start with these 6 pillars of value, and I'll just call out 2 examples. Again, I'll use the same ones that I've used. So for asset management, that's so Coke or Pepsi, for example, have 1 million of these refrigerators out in the field, and they need to know where they are. And so we're able to track them because they lose about 15% of them. And of course, that means 15% less revenue, 15% replacement cost, etc. And so we, for one customer, we were able to reduce that loss by almost up to 100%, so cut it almost right out. For another one, it was 45%. So that's a huge benefit for them. The more sophisticated customers, though, are using things around the technical performance as an example. So we're actually able to, with algorithms, by monitoring vibration and energy usage and the number of times the door opens and closes, actually predict when a refrigerator needs to be maintained and what they're going to need to do to maintain that refrigerator. So they can get out there before it breaks down with the right parts and keep their refrigeration unit in operation. And so we have, different use cases, which are all on our website if people wanted to look, across each of those 6 value pillars about how we help customers improve the performance of their refrigeration fleets. And this is millions and millions of dollars of impact for them.
Oh, fantastic. Yeah, really, really real world benefits there. Now they've got to go to the questions again. You mentioned sort of global supply chain disruptions. I mean, do you have a view? The question is, how much longer do you see global supply disruptions affecting the business? Is that something you have any thoughts on?
I think we're in a much stronger position than we were 6 months ago. We redirected most of our engineering time to redesign our products so that we could use components from multiple suppliers. And what that's allowed us to do is have more certainty about supply. Is it all over? No. But, from our perspective, we've bought inventory, we've made the changes that we feel are necessary to allow us to be in a good position. And I think you'll see our second half of performance will reflect that. So, we've got manufacturing capacity lined up. We've got components lined up. We're in for a big second half of the year.
Excellent, thank you. Greg, audience question here. How do you plan to reach the large markets with a New Zealand-based sales force?
Yeah, we have people all around the world, actually. So we have teams in different countries around the world. So we have a big team in Latin America, and North America. We have people in Europe. So our sales effort is actually outside of New Zealand. So we actually, in New Zealand, we have our technical teams that are designing and building new solutions or supporting the solutions globally, but our sales effort is in region.
Excellent, thank you. And we've probably got another time for another question. Again, you've spoken about how significant is revenue from your technology in your business model?
Sorry, I missed that question, James.
Do you want me to repeat the question?
Yes, if you could repeat it now.
Oh, so how significant is recurring? How significant is recurring revenue in your business model?
It's growing, I guess, is the best way to talk about it at the moment. And so, you know, we've started off with this, it's been a small component of our revenue, but the solutions that we're now offering to the market is seeing that grow rapidly. And it builds over time, because in year one, you get a small amount of it, but then in year two, you get the new revenue and some from the previous year, if you like. So it's a building portfolio. So we expect to see the recurring revenue component of our business be significant over time. It's where our focus is. It's on that software and IoT solution.
Absolutely, sure. Okay, Greg, we're going to leave it there just in the interest of time, but thank you so much for joining this morning. Been really fantastic insight into the business. I'm sure we'll catch up soon. So I'll let you go. Thank you so much, Greg.
Thank you, James.
And then to all our audience members, thank you so much for joining again this morning. I hope you found it very useful. Recording will be on YouTube. As I said, any other questions you want to ask our presenters, do fire those through. We're going to be back in October after the school holidays with another investor webinar. Until then, take care. Thank you very much. Bye.